All right, let's talk about Corning. The stock has been on an absolutely insane run, posting a mind-bending 325% surge. Now, a move like that, it's made some investors a ton of money. But for everyone else watching from the sidelines, it brings up the big question, the one we're here to answer today. Is it too late to get in on the action? I mean, just look at this chart. We're talking about a stock that went from a 52-week low of around $40 to where it is now, about $171. That's staggering. Wall Street has completely repriced this company, and it feels like it happened overnight. So the dilemma for you is pretty clear. Are you buying into the start of a multi-year megatrend, or are you just becoming exit liquidity for the early investors cashing out at the top? Okay, let's dig in and find out. So to really get what's happening with Corning, you have to see it for what it is. We're in the middle of a massive AI gold rush, right? Well, Corning isn't digging for the gold. Nope. They're the ones selling the picks and shovels to all the miners. So what's really driving this incredible demand? Well, this right here. This is the secret. It's the real bottleneck in the whole AI boom. Look, we all hear about the chips, right? The fancy GPUs. But what's the actual challenge? It's connecting all those powerful chips together. When you build these giant hyperscale AI data centers, the need for high-density fiber-optic cable just goes through the roof. The bottleneck isn't the silicon, it's the physical wiring. And that has created this massive supply-demand problem, which for the suppliers means it's a seller's market. And guess who's sitting right at the top of that food chain? And that, my friends, is what we in the business call a classic picks and shovels play. It's a brilliant strategy, really. Instead of trying to guess which company is going to build the one winning AI model, you invest in the company that provides the essential gear that everybody needs to even play the game. It's an incredibly powerful place to be. Okay, so Corning found themselves in this perfect position. How did they capitalize? Well, they went out and built what looks like a completely unbreakable competitive moat. They've essentially locked down the entire supply chain for this stuff. Let's look at the 3 pillars of that fortress. Pillar number 1, the clients. And we're not talking small-time stuff. We're talking a massive, multi-year, $6 billion deal with Meta. Yeah, that Meta. They're going to be supplying the fiber for all of their new AI data centers, starting in 2026. I mean, that's about as close to guaranteed revenue as you can get. All right, pillar number 2, scale. To handle that giant Meta deal and all the others coming, they've pumped $267 million into a new plant in North Carolina. And let me be clear, this isn't just some factory. It is now the largest fiber optic plant on the entire planet. They are scaling up so fast and so big that competitors literally can't even dream of catching up. And finally, pillar number 3, the tech. And honestly, this might be the biggest game changer of them all. Their new multi-core fibers are coming in 2026, and they are incredible. Think about it like this. They can pack 4 times the data, 4 times the capacity into the same old strand. But here's the kicker. They also reduce the physical weight and size of the cable by a whopping 70%. For data centers where space is everything, that is a massive, massive advantage. So you see what's happening here, right? You take a locked-in mega client like Meta, you add unmatched manufacturing scale, and you top it off with game-changing world-class tech. What do you get? You get a moat so wide and so deep it's almost impossible for anyone else to cross. That, right there, is the bull case for Corning, and it is a powerful one. But a great story is one thing. The numbers have to back it up. So now it's time for a financial reality check. Let's pop the hood on this thing and see what's really going on. And you know what? At first glance, things look pretty good. You can see revenue is bouncing back big time, expected to hit over $15.5 billion in 2025. But here's the number that really caught my eye, the return on equity. It's set to triple. Now for you, what that means is they're not just making money. They're using their money incredibly efficiently to generate even more profits. That's exactly what you want to see from a company in a boom. Okay, so the recovery's looking good. Efficiency is off the charts. It all seems perfect. A little too perfect, maybe. Is there a red flag here that we're missing? And yep, there it is, the debt. The company is sitting on over $8.4 billion of it. Now look, with the kind of money they're making, it's manageable. But let's be real. In the high interest rate world we live in today, a debt load that big is like an anchor. It's a constant pressure that you, as an investor, have to keep a very, very close eye on. But honestly, the debt isn't even the biggest concern for me. It's this, the valuation. A price-to-earnings ratio, a PE, of over 93. Let me say that again. $93. That is astronomical. We're talking about a stock that is priced for absolute, flawless, no mistakes allowed perfection. And that is a dangerous game to play. And that really gets us to the core of the problem here. The market, Wall Street, it's gotten way ahead of itself. It is priced in not just this year's success, but years and years of perfect execution. When a stock is priced this high, there is zero, and I mean zero margin for error. One tiny slip-up, one slightly disappointing earnings report, one whisper of a slowdown, and a stock with a 93 PE can fall and fall hard. All right, so we have the bull case, an incredible, unstoppable company with a deep moat. And we have the bear case, a valuation that's stretched to the absolute limit. It's time to put it all together. What's the final verdict? Is Corning a buy, hold, or sell right now? So let's lay it all out side by side. On one hand, the bull case is just undeniable. You've got a near monopoly grip on a critical piece of the AI puzzle, that massive meta contract, and tech that's second to none. But on the other hand, the bear case is just as strong. The current price already assumes all that good news happens perfectly. You've got that $8.4 billion debt load hanging around, and the company is super vulnerable if big tech decides to tighten its belt. So, after weighing everything, what's our official call? Here at Stoxcompare, our verdict on Corning, at this specific price, is a hold. And for those of you who've been riding this amazing wave up, it's probably a good time to think about taking some of those chips off the table.
So let's make this super simple and actionable for you. Number one, if you're already in and you've enjoyed this monster run-up, first off, congratulations, seriously. Our advice would be to trim your position, sell a little bit, lock in some of those gains. You can never go broke taking a profit. Number two, if you're on the sidelines thinking about jumping in, do not chase this stock. This is the definition of chasing a peak. Be patient, wait for the market to pull back, for things to cool off, and look for a much better entry point down the road. Look, the question isn't, is Corning a fantastic company? It absolutely is. The question is it a great investment at this price? And right now, the risk-reward just isn't there. Patience is your best friend on this one.